As of this month, the United States government owes just over $39 trillion, a figure that grows by roughly $8 billion every single day, which means that somewhere around the time you finish watching this video, the number on the U.S. Treasury's own public debt clock will already be slightly out of date. If you tried to count that debt out loud, one number per second, without ever stopping to sleep or eat, you would still be counting more than 1,000 years from now. And here's the part that should actually concern you. This debt is never going to be paid off. Not eventually, not by some future administration, not ever, in the way you or I would think of paying off a loan. And the strange part is, that's not really a conspiracy theory. It's closer to an open secret among economists. And there's a well-documented historical precedent for exactly how a government, this deep in debt, gets out from under it, without ever technically defaulting. This is a real, measurable phenomenon that economists have a name for: financial repression. And the reason it matters to you personally is that it doesn't just erase government debt. It quietly reaches into your savings account and does the same thing to your money. So let's ask the actual question a government in this position is facing. When you owe more than any country in human history has ever owed, what are your options? It turns out there are really only three. And once you rule out two of them, the third one starts to look less like a choice and more like an inevitability. Option one is austerity. Raise taxes dramatically and slash spending until the budget balances and the debt starts shrinking. The math here is brutal. A meaningful dent in a debt this size would require either roughly doubling federal income tax revenue or eliminating enormous, politically untouchable chunks of the budget, most of which is tied up in Social Security, Medicare, and defense. No elected government in modern American history has been willing to do this at anywhere near the scale required, and there's no serious reason to think that changes soon. Option two is default. Simply stop paying. Argentina has done this multiple times. Russia has done it. For most countries, a default is painful but survivable. For the United States, it would be closer to detonating the load-bearing wall of the entire global financial system, because U.S. Treasury bonds are the single asset that banks, pension funds, and foreign governments around the world treat as the risk-free baseline for pricing everything else. An actual U.S. default isn't really off the table, so much as it's a scenario nobody with any real power is willing to seriously entertain, which leaves option three, and it's the one that history says actually gets used. You keep paying every dollar you owe, on time, in full, but you quietly make sure each of those dollars is worth less than it used to be. You don't cut the debt. You shrink the currency underneath it. And we know this works because the United States has already done it once, at a scale genuinely comparable to today. By the end of World War II, U.S. federal debt had climbed to somewhere near 110% of the entire economy's annual output. A debt burden in the same range, proportionally as what the country carries today. And yet, by 1975, that ratio had fallen to roughly a quarter of GDP. According to research by economists Carmen Reinhart and Belen Sprancia, published through the IMF and widely cited since, a substantial share of that decline came from a specific policy combination. The Federal Reserve and Treasury actively capped interest rates on government debt and on many private loans through tools like Regulation Q, while the broader economy grew and inflation ran at a level that, combined with those capped rates, meant lenders to the government were quietly earning a negative real return year after year. Economists sometimes describe this using the Mercatus Center's framework of debt reduction channels, and by their accounting, well over half of that 70 percentage point drop came specifically from nominal economic growth consistently outpacing the interest rate the government was paying, a mathematical condition that financial repression makes possible by holding rates artificially low. And the United States wasn't running this playbook alone. Britain came out of the war in arguably worse shape. Net UK public debt peaked at around 252% of GDP in 1946, a burden that would be almost unthinkable by today's standards. The British government leaned into financial repression just as deliberately, capping long-term government bond yields at roughly 2.5% to 3% through the late 1940s, while capital controls made it difficult for domestic savers to simply move their money somewhere offering a better return. A quarter century later, By 1971 to 72, that ratio had fallen to just over 62%. Economists studying the UK case attribute roughly 60% of that decline to the same basic mechanism we just walked through for the United States. Nominal growth quietly outrunning a suppressed interest rate, with the rest coming from more conventional budget surpluses. Australia and Italy, which ran noticeably higher inflation over the same stretch, saw the effect move even faster. By some estimates, the real value of their government debt was being eroded by something in the region of 5% a year, almost entirely through the currency losing value rather than any deliberate belt-tightening. It's worth pausing here, honestly, because this is exactly the kind of claim that's easy to overstate. Not every economist agrees on how much of that post-war decline was deliberate policy versus simply a booming post-war economy growing its way out of the ratio. There's a real published academic debate about exactly how much credit financial repression deserves versus plain economic growth. What's not in serious dispute is that the mechanism itself, governments holding interest rates below the rate of inflation on purpose for years at a time, is a real, well-documented tool, not a fringe theory. So here's the actual math, using today's numbers instead of history's. Say the government is paying an average interest rate of roughly 3.4% on its debt, which is close to the real figure right now, while inflation is running close to 3.3%. On paper, that already means the government's real inflation-adjusted cost of carrying that debt is close to zero. It's borrowing at a rate that barely outpaces the currency's own quiet decline in value. Now push that inflation rate even modestly higher than the interest rate the government is actually paying, and the debt starts shrinking in real terms every single year, automatically, without a single spending cut or tax hike, just through the ordinary math of currency losing purchasing power faster than the debt accrues interest. That raises an obvious question. If this trick is that simple, why doesn't the government just let inflation run much hotter and erase the whole thing overnight? The honest answer is that it can't move too aggressively without the whole system revolting against it. And there are a few real, documented mechanisms that make the process quiet and gradual rather than sudden. The first mechanism is regulatory demand for government debt. Since the aftermath of the 2008 financial crisis, banking regulations under frameworks like Basel III require banks to hold a certain buffer of what regulators call high-quality liquid assets in order to meet their liquidity coverage requirements, and U.S. Treasury securities are the textbook example of an asset that qualifies. This means a meaningful slice of the demand for government bonds isn't coming from investors freely deciding treasuries are a good bet. It's coming from banks that are required by law to hold a certain amount of them, regardless of the yield on offer. That's a real regulatory structure, not a rumor, and it does mean a portion of the buying pressure, keeping government borrowing costs down, is essentially mandated rather than market-driven. It's worth seeing exactly how this debt is actually held today, because the picture is more layered than the government just owes money to someone else. Of the debt held outside government accounts, roughly a third is owned by foreign governments and institutions, with Japan, the United Kingdom, and China as the three largest single foreign holders, while just over half sits with domestic banks, pension funds, mutual funds, insurers, and individual investors, many of whom are holding it, partly because regulation nudges or requires them to. The Federal Reserve itself holds a multi-trillion-dollar slice on its own balance sheet, larger than the top three foreign creditors combined, a legacy of the bond-buying programs used to support the economy in past crises. So, when people talk about the government owing money to itself, this is what they mean. A meaningful share of the debt is really the government, through the Fed and through regulated domestic institutions, financing itself in a loop that doesn't depend entirely on outside creditors staying willing to lend. The second mechanism is genuinely one of the more contested corners of economics, how inflation itself gets measured. The Consumer Price Index has been revised multiple times over the decades, including changes recommended by the 1996 Boskin Commission to account for things like consumers substituting a cheaper product when prices rise, and adjustments for quality improvements in goods over time. Whether these changes make the index a more accurate reflection of real cost of living, or whether they understate the inflation people actually experience, is a long-running and genuinely unresolved argument among economists. It is not settled science in either direction, and you should be skeptical of anyone on either side who tells you it definitely is. The third mechanism is the Federal Reserve's own balance sheet. When demand for U.S. debt from traditional buyers, including large foreign holders, softens, the Fed has, at various points, stepped in to buy Treasury securities directly, a practice known as quantitative easing. This does keep government borrowing costs contained, but it also expands the money supply, which is one of the channels that can put upward pressure on inflation over time, which, per everything we just walked through, is also the mechanism that erodes the real value of the existing debt. Put those three pieces together: regulation that manufactures demand for government debt, a genuinely contested method for measuring the inflation eroding that debt's value, and a central bank that can step in as a buyer when needed. And you get a system that can quietly run financial repression for years, without most people ever noticing the debt is being managed this way at all, rather than simply being paid off. It's also worth looking at a country running a version of this experiment in real time right now, because it shows this isn't a free pass that lasts forever. Japan has carried one of the highest government debt loads of any developed economy for decades, sitting somewhere between 200 and 235% of GDP, depending on how it's measured, financed for years by a central bank willing to hold interest rates at or near zero, regardless of what that meant for savers. About as textbook an example of sustained financial repression as exists anywhere in the modern world. But it isn't holding indefinitely. The Bank of Japan has been walking rates up from near zero, with policymakers signaling a target somewhere around 2%. And Japan's own finance ministry has had to raise the interest rate it assumes for calculating next year's bond payments to 3%, the highest assumption in almost 30 years. Debt servicing costs that were negligible for a generation are climbing fast. Japan, in other words, is a live example of what happens at the other end of this process. Repression can hold for a remarkably long time, but eventually, if inflation or global rates move against you, the bill comes due in the form of interest payments a government can no longer avoid. None of this means collapse is imminent, and it's worth being direct about that, because it would be easy to end a video like this by implying otherwise. What the historical record actually supports is narrower and, honestly, more interesting. A government this deep in debt has a strong, well-precedented incentive to prefer a little too much inflation over honest austerity or outright default, because inflation is the version of the three options that nobody has to vote for. It's worth being specific about who actually carries the cost when this plays out, because it's easy to nod along to a macro story like this without connecting it to anything personal. If you're holding cash in a standard savings account, earning something close to the national average interest rate, and inflation is running anywhere near the level we discussed earlier, your real inflation-adjusted return is close to flat at best and negative at worst, which means the purchasing power of that money is quietly shrinking every year. You leave it there, regardless of what the balance on the screen says. That's not a hypothetical. It's the same mechanism running on your bank account instead of the government's balance sheet, and it's precisely why financial repression is sometimes described by economists only half-jokingly as a tax that doesn't require a vote. It never appears on a pay stub, nobody has to pass a bill authorizing it, and yet it transfers real purchasing power away from anyone holding cash or low-yielding fixed-income assets toward anyone holding assets that tend to rise with, or ahead of, inflation, equities, real estate, and other real assets among them. That asymmetry is a large part of why the same period of financial repression that shrinks a government's debt burden also tends to widen the gap between people who own appreciating assets and people who don't, which is worth remembering the next time you hear that gap described as some kind of mystery. Which brings us back to that number ticking upward on the debt clock. It isn't a scoreboard that eventually gets reset to zero. Historically, debts at this scale don't get erased so much as they get quietly outlived by a currency that keeps losing value around them. And the honest, if uncomfortable, question worth sitting with is who ends up paying for that shrinkage in the meantime. If a similar policy really is underway again, the bill doesn't disappear. It just moves, gradually and mostly invisibly, from the government's ledger onto everyone else's savings account. If you think this framing holds up, or if you think it's overstated and the post-war comparison doesn't really apply to today, say so in the comments. This is genuinely one of the more actively debated corners of economics, and it's worth hashing out. And if you want the next piece of this story, there's an even stranger precedent for what a government does when it decides it needs more direct control over how people hold their money. In 1933, the United States made it illegal for ordinary citizens to own gold. That's next.